Financial independence is a dream that many would like to achieve in life. Imagine having the ability to live off passive income with the financial freedom to be able to do anything you want to do in life, instead of every day being stuck at a job doing what you would rather not be doing. Yet, amassing the amount of wealth required to generate that passive income is a daunting task that frustrates even the most disciplined person. But what if you could find a method that could generate returns of 100%, 200%, or even more in a year or two? You could reach that financial freedom much quicker. So, what can you do? One method is by purchasing individual stocks. In an ideal investing world, you could just buy a stock as it bottoms and sell at its absolute peak. The reality is different, however. It's nearly impossible to be lucky enough to time the bottom or the top of a stock. Also, trying to buy a stock as it's falling can cost you dearly, as you never really know how low a stock may sink, and some sink all the way to zero. So, right after you hit the like button and subscribe, I'll tell you the secret. Here's the secret. It's to buy high and sell even higher to achieve the best mix of low risk and high reward. The concept is really simple. If you think about it, in order for a stock to rally 20%, 100%, 200%, or even 1,000%, it must first make a new 52-week high. So, if you only focus on the stocks that are making 52-week highs or all-time highs, that's the chance to get the best results. The staggering majority of individual investors, whether new or experienced, take delightful comfort in buying stocks that are down substantially from your peaks, thinking they are getting a bargain. But extensive studies show the old adage of buy low, sell high is completely wrong. In fact, the exact opposite is true. What seems too high in price and risky to the majority usually goes higher, and what seems too low and cheap usually goes lower. The trick is to buy stocks that look too high for the majority of investors. These are the best companies in the best industries doing the most amazing and profitable things. You can sell them after they move substantially higher and have a chance at truly amazing gains. Something to look for in a stock you're interested in is what's called a base. It's basically a cup-shaped formation on a stock chart where the stock moves lower and then, after a period of time, moves higher again. This formation is important as the stock price moving lower tends to shake out any weak-handed investors. Once all of the sellers have been shaken out, those with conviction in the stock can then bid the price higher. The ideal buy point for purchasing a stock is right as it's clearing its ideal buy point. The buy point is defined by adding 10 cents to the highest price in the left top of the base, the highest point in the handle, or another key level of resistance. A handle gets its name from picturing a coffee mug. A handle forms just a little bit lower than the top of the cup on the right side of the base. On a stock, the price may move up from the bottom of a base and rally to within 15% or so of the previous high, and then tend to drift lower for a number of weeks. If the price does not go too much lower, and if the daily volume is lower than typical, that's an ideal handle. The proper buy point is 10 cents above the top of the max price in the handle. Once the price passes the buy point, you can buy the stock up to 5% above the buy point. Buying any higher than 5%, and you have a much higher chance of a stock reversing lower than when you purchased it. Also, volume on the breakout should be stronger than typical. 25%, 50%, 100%. The higher the volume, the better. An example of a stock moving higher on a weekly chart is Eagle Materials, ticker EXP. In 2005, the stock provided plenty of opportunities for investors to buy during its run-up at point 1. Each point provided a base where the proper buy point of the stock was 10 cents higher than the previous all-time high. I want to emphasize that point again. The proper time to buy is when the stock was again making an all-time high, not when it was below the high. If you purchase below the all-time high, you run the risk of trying to catch a falling knife. It will injure you. Note that after rallying for a year and rallying to all-time highs, the stock started falling from its top on heavy volume, 0.2. This was not the time to invest. 7 down weeks in a row, 6 of which were on above average volume, were certainly a negative sign. It's easy to think you'll get a stock at a bargain price by purchasing it on the way down, but the stock sank 57% from peak to trough at 0.3. Meanwhile, you'd miss out on other far more profitable opportunities in the market. Averaging down can prove to be a risky strategy. You might get lucky and buy a stock that will again rally from the dip, or you may end up throwing good money after bad and running the risk of owning a stock that never recovers. The best option is to only buy stocks breaking out of bases and making new all-time highs. Remember, a stock can't score 1,000% gain before it makes a new all-time high. So, look for those stocks making new all-time highs.